Hello everyone, it's Brian Harris with Harris Mortgage. We're talking about the July monthly mortgage update. This month we're going to be talking about rates, payments, deals falling out of escrow, and payment shock. Let's get started. Well, we start each month with an overview of rates, what they're doing. You can see on this chart, they're sideways to just slightly up. And that's because this is a monthly chart. So it just has a data point at the end of the month, where you started, where you ended. But if you looked at a daily chart of June, you'd see rates shot up and then they came back down. So if in the middle of June, June 15th, you were locking a loan, you might have been locking a loan with a 6 on it if it's a conventional loan. So they shot up, shot back down, moved essentially sideways, give or take, an 1/8 of a point. So you can see also, if you look longer term, not just the last month, from the beginning of the year, we're up over 2%, maybe 2.25% from where we started the year. You do see a leveling. The Fed is meeting again end of July. They're going to announce what's believed to be a 50 to 75 basis point increase in Fed funds rate. That's expected. I think that's priced into these rates. But if you had a adjustable rate mortgage or HELOC, those rates would automatically adjust. But I think 30-year fixed is pricing in, like I said, that 50 to 75 basis points at this time. Okay, now we've talked about rates. Let's kind of bring that to life with an example of what a payment's going to look like. So what we have here is a conventional loan payment. Purchasing a house, $700,000, 20% down, so it's $140,000 down. There's going to also be some closing costs. Let's assume you need about $150,000 in cash for this scenario. Now, what we're looking at is a 30-year fixed, principal and interest payment. You also have the homeowner's insurance, and you pay your property taxes. So if all in, roughly, you're looking at about a $4,000 housing expense to buy a $700,000 house with 20% down. Now, how much income do you need to qualify for that? Now, again, we're speaking generally. $8,000 in income is what you're going to need, and that's assuming you don't have any other debts. So an $8,000 a month income is going to give you a 50% debt to income ratio. You might not qualify. You might need a little more income than that, but this is just generally getting you in the right ballpark. And then additionally, so that, let's see, that $8,000 a month translates to $96,000 annually. So let's say you need $100,000 plus to qualify for this scenario. There's lower down payment loans, there's other loan programs, but just for this scenario to give you an idea. Also, I'm assuming you don't have any car payments, credit cards, student loans. If you did, you'd have to make more income to offset those. So the question I get often is, I'm looking at buying this car. How's it going to impact my ability to qualify? So again, I can answer that question once I know someone's scenario with precision. But if, again, I want to give you just a general rule of thumb, what you're going to do is you're going to take the monthly payment of the car, you're going to multiply it by 200, and that's going to give you roughly the purchasing power you're going to lose by adding that monthly payment. So $500 car payment times 200 equals $100,000. So $500 car payment is going to lower your purchasing power by $100,000. Again, that's not precise, but that's going to get you in the right ballpark. Now, if you're shopping for a house, you're buying and you have room, you're not at your max, then yeah, you can go ahead and buy a car if your numbers dictate that. But I'm assuming if you're at your max and you buy a car, for example, how much is your purchasing power going to decline? So it's 200. So you can just remember that number. Whatever your payment is times 200 is what your impact's going to be in your lowering of your purchasing power. Next, I wanted to share with you a Redfin article that was posted yesterday. And in the article, it said that 14.9% of pending home sales are falling out of escrow. And that was just a shocking figure to me. So 15% these deals that are in escrow are pulling out. The last time it was this high was right when the pandemic hit. And to me, that makes sense. That was a really scary, uncertain time, and you may not want to make the biggest transaction of your life with such uncertainty. So it makes sense that a lot of deals fell out of escrow then, but it's pretty odd that it's happening so frequently now. So there's definitely a shift taking place. I think my next point is what I'm going to lead to. It could have something to do with the payment shock that borrowers are seeing. Next, I wanted to go over this payment matrix I put together where you can see what the payment would be for principal and interest mortgage payment based on a combination of the rate and the loan size. So if you think that rates have increased between 2 and 2.5% from the beginning of the year, then you can see how the payment has changed for somebody. Where, for example, if you looked at the $750,000 purchase price, beginning of the year, you were looking at a 3% interest rate, $3,200 payment. Now, today, if you wanted that same payment, let's say the rate was 5.5%. That might be a little high, but between 5 and 5.5. Yeah, you're looking at a payment. I mean, you're looking at a loan amount of between $550,000 and $600,000 to have the same payment. So you've lost between $150,000 and $200,000 in purchasing power for what your payment was at just 6 months ago. So it makes sense if somebody was shopping for a while, they had a payment in their head, they get into escrow, and then they realize, wow, this payment's a lot higher than I expected. And I think that that's what's happening. So another way to look at this is, instead of like trying to find a similar payment at a lower loan amount, you could just stick to the same loan amount. Say, you're not going to start shopping at cheaper houses. And you can just see how much your payment's going to go up. So again, sticking at that $750,000 loan amount, previously your payment was about $3,162. Now your payment's somewhere between $4,000 and $4,200. Just based on interest rates and 6-month movement. So we had a lot of action this month. I don't expect the next few months to be more mellow. It's a wild time in the mortgage space. Rates are changing daily. New loan programs, new lenders coming out. I'm happy to share with you what I'm seeing, which I will continue to do every month. So if you find this helpful, like and subscribe and share. But until next month, have a great day. Talk to you soon. Thanks.